Thank you so much for joining us, Michael Roth. Truly a pleasure having you on Brand Equity and ET Now.
It's my pleasure to be here. Thank you.
So I have a lot to ask you about, especially about key events that have taken place in 2018 and over the last few years, where we've seen a lot of changes within the industry. You've made a public statement saying that all the gloom and doom that surrounds the advertising industry and the traditional models, you've dismissed them, saying I don't recognize it. Why don't you recognize it? Why do you have a different perspective than majority of the industry veterans?
Well, I look at our first quarter results, which was we outperformed the rest of our industry. It was positive in terms of what expectations were. And I just meet with clients when I'm out here in Cannes and our people, and I'm very comfortable with the quality of our talent, our resources, and if we bring all our resources together to meet the objectives of our clients, I believe that we are best served to help our clients move the needle. We can bring in our media business, our creative business, which is obviously critical to everything we do. We have our experiential and PR and all the different assets within IPG. When we bring them together, working on a collaborative basis with our clients, I don't believe there's any competitor out there that can do better.
Okay, fair enough. But if I asked you for a moment to remove your IPG hat and wear the industry hat, so as a key player in this industry, all that one talks about, many people have pointed out, and your peers have pointed out, that the traditional structures that one has followed over the years need to reinvent themselves. The way we look at communication per se, advertising and marketing needs to also go through a relook. And your most recent peer, Martin Sorrell, has made statements saying that that we're in a bit of a it's a bit of a chaos at the moment, and hence even his new project, which is S4 Says, challenges the entire traditional model. So given that both of you are veterans of this industry, and we've seen Publicis do some remodeling themselves, what's your view on what's happening from an outside-inside perspective?
Well, if you remember, I came to the industry from the outside.
Yeah.
So what he's looking at right now and what Publicis is looking at right now, we implemented 14 years ago at IPG. What we did when the new management team came in is we looked at all the assets within IPG,
right,
and we said, how can we bring them together to serve a client-centric model? So rather than restructuring our company and repositioning all of our assets, we developed what is known as open architecture. And open architecture is when we bring the best of IPG to meet the needs of the clients without having to restructure our company. So just yesterday, we met with one of our major clients, and in the room were our media offerings, were McCann, we're Huge, we're RGA, all these different disciplines, working together with our client to see how we can together move the needle. We don't have to restructure our company to do that. The restructuring, all that does is address the silos that have been historical in our industry. 14 years ago, we decided we can maintain our business brand equities in terms of reputation and culture. So whether it be McCann, FCB, Mullenlow, they all have their own go-to-market strategy,
sure,
their own cultures, and each of them brings something different to their clients. And why should we destroy that? If we can work together on a holistic basis and meet the needs of our clients, we still are in a better position to foster recruitment, career development, without putting them all together to meet this need.
So you're saying that IPG has remodeled itself, over a decade ago. But are you saying that other traditional holding companies and holding companies per se, sans IPG, is under threat?
I believe that what our competitors are trying to do is accomplish what we've already accomplished on open architecture. They form special purpose companies. We on occasion have special purpose companies that focus on one client, but it still has the open architecture environment where we can bring in other resources. By the way, open architecture is also third parties. So we can bring together not just IPG resources. I just met with a client yesterday who had a resource that they like and they want to continue to use. And my response is, that's fine. They're part of the open architecture. We just plug them in and we work together. So we don't have to go through restructuring. Frankly, this is all accounting. You know, where does the revenue go? And that's the basis of where this industry was. Everyone was fighting for their own dollars, their own profits, and it's all accounting. So if we look at it from the corporate point of view,
Sure.
we can reallocate. Clients shouldn't be worried about who gets what revenue and where the profitability is. They only care about us bringing resources. And it's up to us to allocate based on which of the organizations are contributing and what's a fair allocation of the fees. And that shouldn't be the client's business. That's ours.
Okay, fair point. But if I had to pivot and go on to, you know, an adjoining point, which is the industry itself and its lack of equity, because you know its equity has diminished over the years.
Right.
You know, the industry was talking directly to the C-suite. You know, now it's become procurement. You know, and the access levels and the value that you bring to the table. Your remuneration doesn't portray that, and nor does your status. So, where do you think and we see other players, other hawks, looking at this business as an opportunity because this industry looks vulnerable at the moment from the outside, and they're looking to attack and, you know, grab that very significant share.
Well, if you're asking me, do I think there are too many players chasing the same amount of revenue? The answer is yes. Yeah. But our response to that is they can't offer the full suite of offerings that we bring to the table on a collaborative basis. So if your question is, you know, are the consultants getting into our business? Well, they're trying to get into our business. But as of now, they don't have media. They don't have powerful creative. So it's when we compete with them right now, we do pretty well against them.
But what stops them, you know, from buying out, you know, very powerful media players or
you know,
players?
it's taking us years to develop the strong media offerings that we have now. Sure, they can go in and buy media companies, and you know, obviously, they would be no different than the competitors we're dealing with right now. And we see, and media, for example, is one of our best performing assets.
The industry is in bed with several players. They're vested with many platforms. So where is really that, you know, objectivity? And you know what I'm talking about. So,
well, you know, all I can tell you is clients like to deal with us because we're transparent. We have all the resources. They can get their solutions with us. And if we deliver, what are they? All these other players, they're just competitors. Yes. We've been dealing with competitors since the formation of the holding company. Now the competitors' names are different, and they bring different expertise. Granted, consultants, they bring certain CRM capabilities, system integration capabilities. We don't do system integration. The better answer is for these system integrators to partner with us. So rather than going out and buying all these small agencies that they think they can compete, and if they were to partner with a company like ours and work together, it makes more sense. But nonetheless, we'll compete with them, just like we compete with WPP, Omnicom, and Publicis.
So if I had to ask you to crystal gaze, and I know you're clear about the fact that your company needs no restructuring and it's working for you, your setup. But again, if I asked you to zoom out and look at the industry at large and tell me what does the future holding company look like, what would that be?
Well, look, if you just look at where we're investing our dollars, we are making significant investments in data and analytics because that is those type of insights are necessary, not just from a media point of view, it's also necessary from a creative point of view. It's powerful for our creative people to have insights as to who the consumer is, how are they being located, what are they looking for. So we've made significant, and we will continue to make significant investments in data analytics. And it won't be just for the media part of our business. So we moved data analytics out of Media Brands, which is our media holding company,
Sure.
into IPG. So all of this data and analytics, proprietary information, third-party information, would be available to all the agencies within IPG to provide insights for them to respond to their clients' needs in terms of reaching the consumer. And we will continue to invest in that.
Michael, what's your sense of the current client mood, the client's appetite to spend, the client's sentiment, and the client's trust deficit standing right now with the advertising world?
Yeah, I mean, it's a fair question. Are we in the same position in terms of relationship with clients that we were 20 years ago? The answer is no. There are too many people chasing the same revenue. Are the relationships good? I would say it's a client-by-client basis. Some clients view us as a commodity,
Sure.
and therefore they look for the cheapest price. Other clients look at us as a partner. And if you look at it as a partner, they're entitled to argue about fees, maximize their own margins, but we're entitled to get paid for what we do also. So of course, CPG has gone through a difficult patch in terms of the environment. So do we expect to see the same type of margins for CPG clients as we do for some clients that are really having a great year from an economic point of view? No. But what the beauty of a holding company is, we have all these different sectors that are part of our portfolio. Right now, healthcare makes up 24% of our business. Well, that healthcare is performing quite well, and we're performing quite well. Automotive, tech and telecom, financial services. Now, when you compare to investing in Google, Facebook, Amazon, from an investment point of view, it's a difficult argument to make about our industry. That's where a lot of the questions about our industry is. And that is the growth in our industry comparable to alternative investments? And we have to be able to show that we can deliver growth, expand margin, and return cash to our shareholders. So we've increased our dividend over the last 5 years, average of 25%. That's what's compelling to an investor. And when it shows that we're not able to do that, that's where the sentiment about our industry really comes into play. So you have two different sentiments. You have the investment sentiment and you have the client sentiment. The client sentiment is a function of our resources, our talent, and costs.
Okay.
The investment sentiment is based on their returns compared to other investments. And those are the battles that we're fighting right now.
I'm happy you brought that up. So, you know, I think you're pretty pleased as the captain of the IPG ship with you know, the company's performance. However, we've just witnessed you know, WPP go through, you know, consecutive quarters of you know, bad performance, and we've seen you know, the fate of Martin Sorrell, and who would have thought he would have been an underdog, but here we are today. What is it that you think holding companies have not been able to do over the last few years, which is why you know, the entire structure is under pressure? Well,
first of all, we've been outperforming the WPPs, the other companies within our sector. That's good. Where we're not outperforming is the rest of the market. So from an investor point of view, even though we outperformed our sector, we still didn't compare to the growth in the market. That's the investment issue we have to deal with. But versus our peers, in terms of organic growth, you know, we've been outperforming. Now, am I happy with our results? Well, when you compare it to our competitors, I'm happy we're doing better.
Sure.
Do I think we should be doing better? Of course.
Yeah.
You know, we used to grow at 6%. You know, we're not growing at 6% anymore. The question is, can we get to growing at 6%? And with all these different players chasing the same revenue, it's hard to see growing at that rate. But obviously, we're going to try to do that. Magna just on Sunday increased its forecast for the ad spend on a global basis to 6.4%. But that includes political expenditures and World Cup expenditures. So if you pull that out, maybe we're in a 5 to 6% growth from an ad spend point of view. So there's opportunity for us to continue to grow. And that's what our objective is.
But so why are the others suffering?
Why can't people believe that we're better than they are? Okay, you know, everyone asks me why are you doing better than these others? And you know, it could be that we're better, but we focus on a client-centric environment, and there are years that we have difficulties. You know,
yeah, sure,
that's the nature of the business.
But Michael, would you now say that you've been very clear and focused about your approach? Would you say that scale is something you would now like to chase?
Look, I think scale is important, particularly on the media side of the business. We have more than enough scale to have a seat at the table. So I'm not worried about our competitors being in a position to cut better deals than we are, because we are big. Certainly compared to the next level of competitors, it's not even close.
Sure.
So we have scale, and I don't need to be big just for the sake of being big. We have the McCann World Group, is arguably one of the largest networks in the world. We have FCB, we have Mullen Lowe, we have Media Brands. We have plenty of scale. The issue is how do we get them to all work together on a common goal and frankly get paid an appropriate fee.
Presented by Mathrubhumi, the most formidable media force in Kerala.
Indian markets have created over 20 lakh crore of market cap in last 1 year. But have you missed the rally?
Here's your chance to rise with India from the start of the trading day to when the closing bell rings. Every 5 minutes, one big money-making idea that suits every pocket.
From multi-bagger to trading ideas. Stay ahead of the pack only with ET Now.
Your one and only destination to make money.
Amazon Prime Day शुरू हो रहा है 16 जुलाई 12 noon से, यानी टॉप प्रोडक्ट्स पर मिलेंगे टॉप डील्स only for 36 hours. Amazon Prime Day starts 16 July 12 noon.
Precious Metal Collection, body perfumes for men. Wildstone Code.
What are your what are you hearing from clients? And I'm sure you've had the opportunity to meet a number of them here in Cannes. Given that over the last couple of years or so, we've had a lot of clients, especially P&G, Mark Pritchard in particular, talking about the fact that that the gloves for digital are off. That this is there's more hullabaloo around it than actual efficiency. Because leaders, client leaders would not be afraid and fearless to put this point of view out. How many clients are following their lead? And what is the kind of sentiment you're seeing when one talks of that part of investment?
First of all, you made a comment before about we no longer meet with CEOs. By the way, since I've been here, I've met with 3 CEOs. And before that, I've met with CEOs. And their message to me is very simple. We believe in spending advertising dollars to build our brand. It's up to you to show how we can be efficient at it and move the needle. Now, whether we're spending on digital and it's not effective, or linear TV, or experiential, or PR, that's the value we bring to the table. And if we can talk to our clients and say, this is where you should allocate your dollars on a return on investment that makes sense, and we will move the needle, when we're in agreement, we'll provide those services and get paid a reasonable amount. Our clients believe in spending marketing dollars. The hullabaloo about whether digital is effective or not and it belongs someplace else, we need the tools to prove that the marketing dollars that we're spending is providing the right return on investment.
Yeah, right.
And if we can't do that, then clients shouldn't be spending the money.
What would be your current, your your traditional digital skew, I mean ratio?
Ours, well, if you look at the spend on Magna, on a global basis, I think digital is roughly 45-50%. In the U.S., it's 60%. Obviously, digital is overtaking TV in terms of the spend.
Sure.
So digital is clearly the place where all the action is taking place. But there's a lot of things happening within digital. And of course, over the top, what's digital, what's TV? It's all getting blurred together. So and that's why our job is relevant today. Someone has to help our clients allocate and work their way through the myriad of distribution opportunities that are out there.
Now, I only asked you this question as a precursor to my real question of understanding and you know, pardon my ignorance and please help me understand. When we see that the digital ratio versus the traditional ratio, the digital ratio increasing, let's say it's 60-40, and hence all holding companies will also look at that skew going forward. How does that help your margins, you know, and to ensure that you're still healthy? Because, you know, the digital margins, are they really as, you know?
It depends on what part of the digital piece. Years ago, there was a study that was done. When you're allocating dollars between TV and digital, in TV, the cost of the dollars is greater than digital.
Right.
But the cost of production for digital is greater than the cost on the TV. So a share of dollars goes on the production side, a greater percentage, if we're doing the production, comes to us on the digital side. So we have a mix of margin between digital and traditional TV. We are agnostic in terms of where clients should spend their money.
But which medium gives you better returns?
It depends on how we're spending it and what we're doing with
But what's the
respect to it.
simple answer?
The simple answer is we're agnostic as to whether it's TV or digital. We don't care.
Because you're saying both.
We have a blended rate. When we report our results, we don't distinguish between digital and TV. So we're showing that we can expand margin, which we've done, and we plan on doing the same for 2018, whether we're spending on behalf of our clients in TV or digital.
Okay, I have two rejoinders to this. One is, and this is also not an IPG specific question. I'm saying if the world, you know, is moving towards, let's say, 80% digital, 20% in the future, and hence everybody wants the same skew because they want more and more of that work, isn't that a threat to the current system? Because they are going to be under pressure because their margins are not going to be that great.
I don't know why your premise is that we don't make enough margins on digital. There are different components of digital which we do make margin on.
So you're saying it's the same as traditional?
It depends on what resources and what we're doing. It's inappropriate for you to look at siloed parts of our business. Some parts of our business are more profitable than others. So it's a blended margin. And digital can be as profitable as TV, or TV could be less profitable than digital, depending on what arms of our resources are being used. Are we doing the creative of digital? Digital requires creative, not just...
Yeah, sure.
Okay, so what are we bringing to the total offering? And that's, I come back to the open architecture, and that is, if we're bringing in multiple resources to meet the demands of our clients, we make an appropriate margin when you look at total IPG. And that's why we use the open architecture as our go-to-market strategy.
What is your view of now the fact that, you know, we've seen digital, we've been in awe of it, we have, you know, feared it, embraced it, and now I think, you know, the honeymoon period is over. People are looking at it for what it is. What is your view? Has digital as a medium actually proven its mettle?
You know, obviously there are questions on digital of safety, whether the viewability of digital is real. All of that goes into the factor of whether they should be using digital or they should be doing linear TV.
Exactly.
And again, that's why we provide a valuable service. We help our clients determine which of those allocations are most appropriate for their needs. That's why we exist.
I'm done with the macro questions now. I want to specifically talk to you about what you think of what happened with Martin Sorrell at WPP. It's ridiculous to to fathom that somebody of his stature and his intelligence and IQ would be ousted for visiting a prostitute. What's your reading of the whole situation and your view of leaders?
Well, first of all, I don't know what's true and what's not true.
Of course, these are allegations.
All I can tell you is forget about whether it was a prostitute or not. If a CEO is using corporate money for personal expenses, it's inappropriate. There's a fiduciary duty that a CEO has not to treat the company as if it's his own or her own. And if that's what happened here, then he should not be running the company. And the company should be reimbursed, and that's not the type of leader you want in a company. So I just look at it from a governance point of view. As a board of directors, it's incumbent upon them to make sure that the CEO is focusing on corporate funds used for corporate reasons, and personal expenses by a CEO should not be incurred by the company. And that's my position.
But you and I both know that that amount is very trivial.
It doesn't matter. And by the way, when someone says it's not material, if you're a $12 billion company, 500 million could be not material. So I don't know how much money was involved. Mm-hmm. It doesn't matter. Mm. A CEO should not be using corporate resources for personal benefit. And I don't know what's true and what's not.
Sure.
All I can tell you is that's the way CEOs should operate. And if a CEO is not doing that, they don't belong in the job.
And what is your reading of S4? I believe, and he is Martin Sorrell has actually attacked the traditional holding company model and has said that hence he's building a company of the future. What's your view of S4?
I don't know much about S4. Since I've joined this industry, everyone's asking me about WPP and Martin Sorrell. I've competed with Martin Sorrell since I joined this industry. We've done well against WPP. We'll do well against S4.
Last question before I let you go, Michael, and it's really, my hot favorite question is about IPG and whether, it's open to being acquired. And I've asked you this question several times over.
The answer was as follows. You don't do a transaction unless you need capital, or you need a resource that you don't have, or there's a price on the table that you feel is in the best interest of the shareholders. We don't need capital.
Okay.
There's no resource that we don't already have, which we continue to invest in. And if someone ever comes forward with a price that's attractive to our shareholders, I will talk to them. And I said that to you when our stock was $10 a share, when it was $15 a share. Now it's $23.50 a share. And here we are.
Well, I definitely should have bought the stock. On that note, thank you so much, Michael Roth. Truly a pleasure having you on Brand Equity Now, and looking forward to meeting you again in India.
It's my pleasure. Thank you.